Good morning. Happy New Year, everyone. It is January 2nd, 2019, and the market just opened for trading in 2019. And we got a little gap down here, a little gap down at the open. And so today, what we're going to do is I'm going to dial Jeffrey up here in a minute, and we're going to go over all the new stuff that we're rolling out in the new year in the Investing Systems trading service. As you can see on the home page, we have a system notes section. And I updated the note over the weekend to say that the brand new fully automated system is live as of January 1st. And obviously, since this is all brand new, you'll want to start off by reading the documentation on the strategies page. Let me pull this down a little bit here so you can see that. Yeah, so we've simplified everything. We've automated, whole new paradigm shift, and we're pretty excited about this. This is really going to be a good system to use in the new year. So the strategies page has a lot of documentation on it that you'll want to go over probably a couple of times, and there will be new material added to it as we go forward. And there'll be a lot of new things coming in the new year too. What we have right now is basically the first sort of the first module in here, and we have the ability to add a bunch of new stuff. So this is really going to be slick. Yeah, I read over the strategies page a couple times over the weekend while we were editing it, and I realized at the time that it's a lot to absorb, and so you probably want to read over it a couple of times. A lot of the questions that we've had recently should be covered there now. And so if anyone has a question that's not covered there, feel free to email us and we'll be happy to answer it. But I suggest you take your time, read through the material over here, and I think you'll get the answers to most of your questions. So I thought today we would do basically a little overview of the entire system, how it works, how you can actually use it, and some of the nuances. And so with that said, I believe that I'll go ahead and dial Jeffrey up. So we'll see how the sound is, and we'll do like a little sort of a tutorial type of show today. Good morning, Jeffrey.
Hey, Bill.
Welcome to the show.
Bright and early out here on the West Coast. Actually, it's still dark and early out here on the West Coast.
Huh.
But Happy New Year to everybody.
Happy New Year. Yeah, I put Happy New Year right here in the system notes on the home page of the brand spanking new Investing Systems trading service. So we've actually had the system live now for what? Most of last week. We did a little tweaking to it, and we got some documentation in there. And so I thought today would be a good day to kind of just go over the basics of how one would navigate and use the trading service. And of course, this is a swing trading service. It's basically going to provide stock picks, swing trade setups, entries, exits, trailing stops, everything one would want to be able to do some short-term trading. So where do you think we should start? Do you think we should start on the data tables?
Yeah, well, I'll tell you what. Yeah, why don't you go over, let's take a look at each one of the data tables and just kind of talk about what kind of data is in there, and then we can get into like more of like the different strategies, just to kind of do a brief
Okay.
overview of those, and maybe cover some of the topics that are in the strategy page, and just kind of talk about those. And do folks have ways to send questions into you?
Yes.
Oh, great. So if anybody has questions along the way, shoot those through. We'll get those answered for you, and then that also helps us maybe put that information in the documentation as well. So
All right.
take it away, Bill.
All right. Well, there's actually a couple of ways to get to the good stuff, the actual swing trades. You can click swing trades from this top menu. You can click swing trades from the middle section here. There's actually kind of there's an intermediate page here that's called just swing trades, and it has the pending trades, open trades, and closed trades listed here. Or you can just jump right to the pending trades from the menu. So it's really kind of easy. Um, I left this page in here in case we want to add some different tables or some different information to it. Um, and so I experimented with putting the pending open and close trades across the top nav, and they don't really fit well. And so that's why I have it as a drop down menu. But
No, I,
basically,
I think it looks great like that.
yeah.
As soon as you get to that page, you got them just all listed there, and you'll see we got a couple tables on each page on the pending and the, well, you can do the tour here.
Yeah, sure, sure. So the first thing that you'll see on the pending trades page is the trades that are actually triggering for today. And if I'm right here, Jeffrey, this means that like this morning, these would be stocks that you would want to get in that you would want to buy as long as they're trading over the trigger price. Is that correct?
Yeah, that's correct. This table here, and we put it up at the top because that's really, these are the actionable trading symbols. So this is going to be probably the first thing you want to see when you pop in here. And you're going to get this information a few hours after market close. We're working on speeding up the processing. It has to do with the data coming down and getting double checked and all that kind of jazz. But soon we'll have this turnkey to where you can probably look for the update within about 3 hours of the close, which is great. The market closes, take a break, come back in the evening, and you can kind of tool around and look and see what's new. And so yeah, you'll have this in the evening before, and you can do some checking of the charts and figure out like which stocks you're interested in buying, and then the next morning the stocks are a buy. Now, in the strategy notes, and the basic premise is that the barrier or the trigger line that is given in this table, that is your point of reference, visual point of reference. If a stock is trading below that, you don't have to worry about it. Just it's you put it on hold until the next day. The next day, in other words, the stock is not actionable until we see it above that trigger line. So a real simple thing is, the first day that we get a close above that trigger line, the stock is ready to go the next day. And we only have a couple different issues with this. We're going to get three different types of open the following day. We're going to get an open that is somewhere near where the stock closed the previous day, right? And if
Mm-hmm.
it closed the previous day above the trigger line, then hey, it's a buy right there. Just boom, pull the trigger. We're going to have days where maybe you had a big pop up above the trigger line on some kind of positive news or just a healthy market day. And then the next day, the stock gaps down, just like we're seeing today. We have a lot of stocks gapping down this morning,
Mm-hmm.
just because the futures were down overnight, and the price is going to be back down below that trigger line. So that's you put that stock on hold. Now here's the thing: the stock gave you a trigger, and if you're a diehard, very experienced trader, and you say, "Hey, I want to jump in here anyway," like because I see other support and on my intraday charts or whatever, right? You have the option to do that, but the trigger line is where you want to kind of base your balance point off of. So that stock could just go on hold, and if you see that stock trade above the trigger line the next day, then it's buy, right?
Okay, so let
The
me.
final, let me give you the final one. The final one is if you have a huge gap up, right? The first day that closes above the trigger line, uh, maybe it's a big long range day, and then we get a big gap up the next day. That's the crapshoot. We get two types of gaps. We get what's called a gap and go. In other words, that stock gaps up and it takes off, and we get a second rally day, and then that swing trading cycle has basically initiated and is never going to look back. And so the only way to trade that would be to just be able to jump in that morning. However, this is a 50-50 coin flip thing, right? However, big gap up stocks could also pull way back. We could pull back all the way to the previous day's high, previous day's close before the stock gets support or no support. It just keeps going back down again. So that's our only little, those are our challenges in taking the entries. Now, I'll just say the final thing. If you read through the documentation, we can talk about this in a minute. I stress heavily that trading and swing trading are accomplished. Your profit edge is accomplished over the big series, like lots and lots and lots of trades, and you want to start off with very, very small position sizes to get the engine rolling, and then later, when your P&L is positive and everything, you can up the position sizes. So if you start off that way, then you can, if you start off really small, you can not worry about too much of the minutia. Basically, if you get a close above the trigger price one day and it's still there the next morning, you just buy your position, put your stop in, and forget about it. Right, and so we can get it down to where it's super simple. I spent a little bit of time on that because the trigger price is the most important part of all this, and having a good understanding about it is important. So I'll let you
Okay,
take
well,
take it away from here.
I had a question. I think that I heard you mention that if you're the type of trader that's watching the market intraday and say like on this first one here, if I was watching this on yesterday, say, of course, we're working over holiday here, but if I was watching this yesterday and it was towards the end of the day and the stock had pushed through the trigger price, you're saying that you could actually jump in that same day, or is it actually preferable to wait until the next day and pull the trigger, so to speak, in the morning?
Well, the easy peasy way to do it, if you want to be a very low impact type of swing trader where you don't have to spend lots of time and fret about too much stuff and just follow kind of a mechanical system, is just wait for the 1 day close, which will appear up in that triggered today list, and then it's just to buy the next morning, right? With your computed position sizes. However, remember I just explained one of the little dilemmas we have. We can get a stock that makes a big move and closes above the trigger line, and then the next morning gaps up and it's on its way. I would say about a third of your swing trades that you're going to watch are going to probably have patterns like that. So on those particular trades, then yeah, it would make sense that, hey, if you're watching the market and 5 minutes before the close, you can tell, hey, this stock's definitely closing above the trigger line today because we're 5 minutes from the market close and we're, a percent above it or 0.5% above it, whatever.
Mm-hmm.
Then you technically it triggered and you could take a position, right? That is going to be beneficial for you on those gap up days, swing trading
Sure.
patterns, right?
Speak.
It's going to be negative on a day like today where things gap back down against us. See, so
It's a
it's a
double-edged
50-50.
sword.
It's double-edged sword, 50-50 coin flip. You can trade that way. You're going to see that you got the cancellation effect. You'll get hooked into ones that'll gap back down against you, and you'll get hooked into ones that are going to gap forward. So you see where I'm going with that?
Sure, sure.
It's yeah. So
Is there
if you want to keep it super simple, you just look at the triggered list and it's a buy the next morning while you're sitting there sipping your coffee.
is there a certain sort of threshold where you would want to pass? Like say that a stock gapped up or opened up significantly above the trigger line, like maybe, two ATRs or something, that you would just want to go ahead and say, well, that it's not a good idea to jump in here because the stock has already made a significant move past the trigger. Is there some sort of threshold that we can use?
Yeah, that's a great question, and the answer is definitely yes. But in any kind of technical analysis or trading or anything like that, we run into the phenomenon of the closer you get to your, filter number, right, or your threshold that you're going to pick, the less the filter has any meaning. You see what I'm saying?
Sure.
So we could say, yeah. And by the way, scroll down to the pending just a little bit. I want to show something there. Notice the far right column there, the
Average range.
the average range. Yeah, we should probably stick that up in the. I was thinking yesterday we probably want to stick that up into the triggered also, so you can the stocks that trigger you can see what their ranges are, and we might be able to key off of that, because you're right. If we're like two ATRs above the trigger line gapping up, you're stretching it there. Um, but yeah, we'll have to think about that, exactly where we want to do that threshold. It's one of those things it can be a little bit subjective, because again, a stock can gap up and it never looks back. That the open is the low of that day, and then you're 5 days later, the stock just keeps going up. So that's a little bit of a tricky thing.
All right, let's move on and talk about the pending trades here, because these are the stocks that have been selected by the system. And I also, real quick, I'll let you talk a little bit more about this, but I wanted to point out that we have added a print button and a download CSV button, which could come in pretty handy for people. I know people like to, maybe print out the list because there's quite a few stocks on it. The CSV will actually allow someone to copy the ticker symbols and paste them into other applications or something like FinViz so that they can eyeball all the charts real quick. So those should be really handy. Those are live and they work. I'm not really sure how useful the search is, because typically, like if you select, 50 or 100 here, you're basically going to see the entire list. And so, but I left the search on there just
Well, the search is for individual symbols, right? You put the symbol in and it finds it.
correct, or the company name. Yep.
Well, yeah. I mean, let's say let's say that you have your own little uh, watch list of favorite stocks, and you may want to, pop in there and check and see if they pop in. That's all. Um,
Sure. If I put in like data, it'll
yeah, if
come
we've got
it'll
a lot,
come
but
to right at the
right, and so you can also sort on the symbol, put it in alphabetical, and it would be easy to just eyeball and scan down and find, a symbol right in
very
the list.
true. Very
Yeah.
true. Alphabetical order.
So, yeah, here's the thing with that is that, there's a lot of stocks out there in the stock universe, and right up front, we filter out what we think are, I guess, what you would call like the garbage stocks that you don't want to trade.
Hmm.
Either they have really low erratic volume, erratic chart patterns. Their ATRs are so low that it would be like watching grass grow to try to trade them. So we try to weed all that out, and then, but the stock in this list, these are the highest momentum stocks you're going to find in the market, right? That's the whole secret sauce behind this system, is that we start off with the strongest. And I don't mean stocks that just made new highs, or, they're the ones that just popped up recently, which is what a lot of those kinds of scans end up being.
Hmm.
These are stocks that have solid support, solid momentum that's built over time. They have smooth chart patterns, right? So we start off with the cream of the crop of the symbols. So if you have a favorite stock, don't get frustrated and scratch your head and say, well, how come my stock never gets in here? These are the racehorses of the the market. So your stock just might not, your stock might be in a funk right now, and it's just never going to be on this list for a while.
Well, sure. There's a lot of big brand name stocks right now that are in persistent downtrends, or
Yeah, all
or
your
in downtrends. And what if I read you correctly? These are stocks that are in longer term uptrends, correct?
they're in longer term uptrends, and they have recent really solid momentum, and they have really nice smooth swings. And that's what we look for. The smooth, there's a smoothness factor and there's a momentum factor. So put it this way, this is probably the best stock scan that we've ever come up with, right? As far as like high momentum stocks. Now here's the thing. There is a ton of ways to play stocks in the market. These are stocks that if you look at a chart, we can put some charts up later. They're basically going to the upside, right? Uh, Stocks that have just recently crashed, you can play the bounce, and there's all kinds of ways to play the market. But there's so many stocks in the stock universe that, we got to narrow the list down somehow, right?
Sure. I was just going to mention that because if we're starting with the entire universe of stocks, right now there's 63 in here, which seems like a lot, but quite honestly, to be able to narrow down the entire universe of stocks over 10, 63 is a pretty reasonable number, considering that like only a handful are going to actually trigger each day.
Yeah, you're going to get a trickle through of the trades that are triggering. Some of them are going to drop off the list, right? Maybe they break down and um, these are stocks that are trading above various support levels that our algos determine, and if they break down below the final levels and stuff, they're toast and they're no longer viable because they've broken their big run on momentum, right? So they fall off the list. Um, and the other thing to keep in mind is that one of the reasons we've got the list that's relatively healthy here is because of the market conditions. We just went through a period where we had a really good sell down, and it really put the reins on a lot of these super strong stocks and pulled them back into the setup pattern, right? So we're getting a
Mhm.
lot of stocks setting up at the same time right now just because of market conditions. In different market conditions, we'll probably see this list drop down a little bit, right?
Gotcha.
We just have a lot of good setups firing off. This might be like the perfect time ever to start this because we got so many stocks that are setting up for us.
All right, let's talk about the different columns in this table here. The current price. So like this system is designed so that if somebody was say working a full-time job, they come home from work in the evening, they log in here, what they're going to see is that the current price, like you said, an hour, couple hours after the close, you can log in. The current price is going to be the close from like tonight after the close. When this gets updated, the current close will be today's close, and obviously the date will be today's date, January 2nd, and the trigger price will be the price that you want to look for the stock to actually close above. Correct?
That's correct. Yeah, a great way to think about this, and we might want to just put the title up there, close for current, so people don't come in and think it's real time. But basically, that's just you know that column, it gives you an idea how much does the stock cost, right? Is it a $10 stock? Is it a $100 stock? Is it an $80 stock? Is it a $50 stock? So that the current price just clues you in, and you can sort on that, right? Maybe why don't you click
Sure.
on that and
Well, and you
sort?
can also see how close it is to the trigger. That was going to be my next thing. So,
Yeah, and so here's the thing about the trigger price that I want to go back to. Uh, don't think of the trigger price as your entry price. Think of it as a barrier to action. So it's a different mindset because here's why. When the stocks come into this pending list, you might see that trigger price quite a distance from where the stock is trading. And that trigger price is representing kind of a noise barrier for that price action, right? So it could be a relatively far distance above the stock, right? So the first thing you don't want to do is come in and say, well, why do I want to buy the stock way up there? Yeah, you're not. We're not telling you to buy it at that price. We're saying that's the barrier. Now, what you're going to notice as the stock setup progresses and develops, you're going to see price is probably going to start to rise, and the trigger level is going to start to drop. So the two will converge nice and tight. And some stocks you'll see will pop up quickly above the trigger price. Other stocks you're going to see that they can get caught in congestion and him and haw around in stuck under resistance for 3 or 4 days, maybe 5 days, and that trigger line is like right. That's the resistance level, right? So that's
Hmm.
how this is designed, and then you'll get the stock break above that level. So we seem to get like two flavors of everything in the market from a technical standpoint, right? That's just the way it works. Day trading, swing trading. In other words, um, we have the two types of entries we could take. We have stocks that gap up, stocks that gap down. So the crossing of the trigger price, we can get really quick, smooth as butter moves that cross it, close above it. Next day they keep going, and the whole thing just as smooth as butter, takes off like a charm, right? Then the other 50% of the trades, we're going to get a tug of war battle at the trigger level. Like that's the level where it's back and forth, maybe a close above, close back below, before the price busts a move either to the upside or the downside. So expect that 50% of the time it's going to be piece of cake. 50% of the time there's probably going to be a battle around that area.
Talk to me about the average range column, which I find extremely useful, and you can sort by that, of course. So tell me how that's calculated.
Yeah, this is what we want to do is we want to figure out we want to figure out on average what is the daily range of this stock. So if we're looking at that first one there, you can see this is. Did you sort on it or the first? What's the first symbol? TGMA.
AYX. Yeah, I sorted on it.
Oh, okay, yeah. So I got a time lag or something. Anyway, there we go. AYX 6.8. That means on average over the past month, it has traded 6.8% range per day on average. So
Gotcha.
that means some days are probably less and some days are bigger. But here's one of the trick things that we do with this to get a smoother reading. Basically, what I do in the algo is I pull the last 26 days, trading days, right?
Hmm.
Now, there's only 22 trading days in a month, in a normal month. So I pulled 26 trading days out. Then I chop out the two biggest ranges and the two smallest ranges because those could be anomalies.
Sure.
They could either be erroneous price data, just for whatever freaky reason,
Hmm.
or they could be just, you could have the freakiest long range day ever because of a news thing and then it like fizzles the very next day, right? And so you don't want that skewing your
So
number that
this is going to vary slightly from a standard ATR, but it's the same concept. Actually, maybe an improvement on the ATR with the way that you're sort of cutting off the anomalies. I like it, but it will give you a really good indication of what to expect from the average price movement, which also will go into deciding which stocks one may want to trade, right? I mean, certain people are more aggressive. They like to trade extremely volatile stocks, and other people, are more, like the lower ATR type stocks. You can see some names in here like Clorox and some of these other ones, P&G, that type of thing, which are more tame stocks, and so you would expect that they would have less of a daily price movement and probably turn into like a longer swing trade than some of the more aggressive stocks, right?
sure. There is something to try to understand about this average range here. Yeah, you could look at it and say, hey, this one's got 6%, daily range, and this one's only got 2%, and therefore I want the one that's got more action. But that could be partially true. Here's the issue, though. Think about it this way. Um, a lot of what we're doing here is we're kind of smoothing things around the edges, because what we're trying to do is play the big series. If, we're assuming that if you like making money swing trading, this is going to be an ongoing thing out into the future, right?
Hmm.
I've been swing trading for 15 years and see no end of stopping, right? So if you're going to make this a business, you're working over the series, the long-term series, and we've got things that are built into the strategy that smooth it out, right? It smoothes out the rough edges over the series. So
Hmm.
back to the average range, here's what you want to think about. Um, the stops that get computed are volatility stops, right?
Okay.
Which are going to be based off of that particular stock. So if a stock's got a big daily average range, you might have a wider stop than another stock, you see.
That makes sense.
So it kind of cancels, you could say, oh, this one moves more, but you're going to have a wider stop. So here's the thing. Uh, in the strategies page, I talk about two ways to uh, compute your position size. And let's say that you were going to use the second methodology. Both of them work fine. So, the second methodology, what you do is you fix your risk per trade. So you'd say, okay, every trade I do, the max risk, barring a big gap down, is going to be $100, right? That's
Hmm.
what you'd say. So you'd use that to compute how many shares to buy, which is then based on the distance between your entry and the stop, which then automatically incorporates the volatility. You see, so what I was trying to say in a roundabout way there is, if you trade it that way, it doesn't matter if it's a high range or low range stock, because your share sizes get computed. You get it?
Gotcha.
It
Gotcha.
all smooths. Yeah, it all smooths out. Uh, so don't fret too much about that. But again, if you're an aggressive trader, because you know there's other ways to use this list. You could day trade off this list. You could uh, buy the stock one day, and if it goes up huge, just sell it at the close, that type of thing. So yeah, you may want to focus on the higher range
All
stocks.
right. Before we move on, real quick here, let's talk about the target and the stop on the trigger today. So these would basically be stocks that I would log in at night and say, okay, if the stock's trading above the trigger price tomorrow morning, sometime around the open, then I want to get in. Real quick, let me ask you this. Suppose, just hypothetically, that you get up in the morning, like today, where the market gaps down, your stock's below the trigger price, and then the market starts to rally. And sometime during the day, the following day, not necessarily in the morning, it moves above the trigger price. Is that a good time to get in? And would you want to get in like, close to the trigger price, or would you want to kind of hold off and see if it can maintain above it? You see what I'm saying? Like, so
Oh
you,
yeah,
you get up in
yeah.
the morning and you say, okay, I'm ready to buy this stock because it closed above the trigger yesterday, but this morning it's trading below it and then moves up through it. Is that when you want to get
Valid.
in?
Yeah, sure. I'd say as soon as you see it go back above that trigger price, it's a buy. Just buy at the trigger price then.
Okay.
Um, yeah, because it's what that stock's doing is it closed above it one day. It got knocked back at the open the next day, but it was able to claw back above that line. So,
Gotcha.
that's a trigger, right?
Okay.
Again, here's the thing. If you treat swing trading correctly, the way we've laid out this system, you're going to start off with very small position sizes and build them over time. So everything kind of smooths out over the series. Uh, so I mean, you're going to have days where if you did that, it's going to work, and you're going to have other days where if you did that, you might get into a stock and then it falls and hits your stop. So it gets down to the 50-50 crapshoot at this juncture.
All right. Last thing before we move on here, let's talk about with a pending trades list, fairly significant. Like there's 60 something stocks on here. I would expect that on certain days, there will be one or two or three, maybe as many as four or five that trigger. And so, talk to me about a lot of people are going to ask about sort of picking and choosing, how many open positions they should have, and how they should basically decide which ones to get in and whether they should like get into a certain number of stocks and then just sort of hold off on taking any more new positions, right?
Yeah, good question. And that this might be one of the trickier little things up front to kind of get started with, is like which ones do we pick, right? Which ones are the best? Well, let's think about it the other way. The first thing is I already talked about this, that these are the cream of the crop out of thousands of stocks, right? And they're in the our specialized swing trading setup, which is like basically like one of our best swing trading setups. Okay,
Mm-hmm.
so once a stock gets on this list, it doesn't get any better technically, right? We can't like do any more fine tuning on the scanning of a stock, right?
Mm-hmm.
It is what it is, and then we're just dealing with different prices and different stocks with different industry groups that may or may not have news. Also, yeah, these everything we can do here is technical, and then it's up to you to do any kind of fundamental or news related due diligence and just check up on the symbol. Eventually you might get a thing where we won't allow a stock like right before earnings. We'll be able to build that into the
Yeah, that might
you know
be a good idea. Or I
that's
was
it.
going to suggest that when we get into earnings season, that people would want to be aware if a stock is releasing earnings like within the next day or two, you probably would just want to take a pass on it.
Well, sure. Yeah. I mean, the best play ever is with earnings is to get into a swing trade about 3 weeks before, or 2 weeks, 2 to 3 weeks before, ride up buy the rumor, sell the news type of a thing. And if you can catch a nice swing cycle where they're buying it up based on the whisper numbers or whatever, and then you just sell your position before the earnings comes out. Now that's a good earnings play, but yeah, you don't want to be taking your entries right before. Now the only other you know safe way to play around earnings is, let's say you're already in a stock and it's already made substantial movement in your favor, and maybe let's say you even cut it in half. You took profits on half, and then you're just protecting the other half. Um, then that's you could say, hey, I like this stock and I will hold through earnings because I am in a no lose position no matter what happens.
Gotcha,
Right?
gotcha.
Yeah.
So back to like how many positions? I think
Well,
I
let's
read
yeah,
in
let's
the
go ahead.
strategies that yeah, like you don't want to over diversify. Like more than 10 open positions is probably too much, and
Well, it's not probably too much. It
it
is too
is too
much.
much. Yeah, and I mean, and being concentrated, like say you decided, well, I'm just going to trade these three stocks, then you're kind of limiting yourself a little bit, and you're being sort of you're concentrating it is the word I was looking for. And so, is there a happy medium
um,
on how many open positions that you might?
yeah, sure. Well, look, there's two kind of ways to approach swing trading. One is, let's say you were a really super busy person, right? And but you got some capital to work with, and you just say, hey, I want to shoot for maybe like 2 to 3 swing trades a month, right? That's totally reasonable. You just keep it real easy peasy. You pick a stock here and there, and you trade it, and you again start off very small, and you can just pyramid your size up, right? That is that's one approach, right? And maybe as your time frees up, you can trade a little bit more. So the other way to follow that same kind of concept is you're still going to trade one stock at a time, but you're an aggressive, hardcore, trader, right? Meaning you're going to really build bigger positions, maybe trade on margin, and get into one. You're going to try to find your best swing trading setup, get into that, and play with bigger firepower, right? So those are two methodologies right there, right? One for the uh, kind of the amateur person that doesn't have a lot of time, and the other for the hardcore, someone that wants to trade bigger size.
Which also brings us to the idea that probably behooves everyone to take a look at the charts too on the stocks, and perhaps you'll see something on the chart pattern there that sort of helps you decide, hey, this one really looks good. I see some support right below, or it just had a pivot low or something like that. So, looking at the charts can be another useful way to determine which one of these stocks that you may actually want to pull the trigger on.
Yeah, well, here's the great thing. Um, these stocks in this system can be used in both ways. You could, in fact, be a heavy-duty swing trader, trade, lots of different positions, and never even look at a chart if you didn't want to, because you've got all the data points right here. You got your stop, start. You'd never even have to look at a chart if you didn't want to. In other words, you could literally trade by, instrument paddle,
Gotcha,
right?
gotcha.
But now most of us are hardcore traders. We're looking at charts, and we may be overthinking things a lot of times by looking at the charts. But yeah, you're right. You can look at the charts, and if you're an experienced trader, you've got a ton and a steady stream of symbols that are high performance stocks, and to work with, served up on a platter. So maybe you've got your own, thing that you methodology that you trade with, day trade with, whatever. Here's your list of stocks to work with, right? These are actionable trading candidates.
Sure.
So, but back to the question about how many stocks. So then the other route is to diversify a little bit. Now, the question is, well, why would you even want to diversify? Why not just trade one stock at a time? Because one of our and this is the double-edged sword again in the market. One of our challenges and our risks is what we call catastrophic gap down. So the thing about gaps is, and a gap is basically, everybody knows what a gap is. The one day we open up and the price is either higher or lower than where it closed the previous day, right? Could be it's mostly news or market driven, like, right? If the market has a big down move in the futures overnight, and a lot of stocks will open lower with it, right? So that type of thing. So gaps, the thing about most gaps, I'd say 98% of gaps, they cancel each other out, right? If you think about it, because you're trading over the series. So what do I mean by they cancel each other out? Because you're going to have gap ups in your favor, where it makes you quick money, right? You open up the computer and it's like, oh, we opened up 5% of from yesterday, right? You're going to have quick gaps in your favor, and you're going to have gaps back against you. But over the series, they cancel each other out. However, there's one nasty kind of a gap. It's called the catastrophic gap, and that normally is most of the time we see it is around earnings.
Sure.
They miss their earnings number. You get a big gap down, and it can be, big percentages. So the issue there is, the only way to defend against that is to diversify, because then you lighten the damage on any one catastrophic gap down. That is the main reason for diversifying. You could argue that if you diversify, you also open yourself up to more possibilities, right? That a stock's going to go up. But then by that same logic, you would open up yourself to more potential catastrophic gap down. So then you got a cancel effect there. You see,
I'm going to say the majority of times what you're talking about, catastrophic gap downs, are happen over earnings. I mean, a lot of these stocks that I'm seeing on the list, that would be probably the number one cause of a big gap down would be earnings. And so
number one cause, and then the other one is, let's say a drug company they don't issue a patent for a drug that they've been waiting on, right? They stop the trials, or whatever. That's a big one.
Not nearly as common.
Not nearly as common, but if you're trading like biotech stocks and stuff, like drug stocks, that you'd see that there. You could see, what else would we get? We could get, negative lawsuit. Let's say the
Bad news, just
the
bad news in
C yeah,
general.
bad news. The CEO was caught, what I'm talking about,
Sure, sure.
in a giant
Yeah,
Ponzi scheme or whatever. The stock's gonna, could have a big gap down the next day.
yeah.
So, but it's one of those things. It's a semi-rare event, and again, it's kind of like, I visited and spent a bunch of time in London, and there was an IRA terrorist bombing in London when I was there, and like a store got blown up like 6 blocks away, right? So it's like, wow, danger, right? Well, I would have had to be in that exact spot on that exact day on that exact time to be hurt by that, right?
Mm-hmm.
I could have walked by that same spot, weeks before, or the day before, or days after, and So what I'm trying to give you with that analogy is that, yeah, the timing. It's almost like winning the lottery. So the timing of getting hit by a catastrophic gap down is it's one of those things like that.
Sure.
You have to be in the stock on that day, at that right at that point.
So
Uh,
the moral of the story is probably avoid holding a stock over earnings, which is something consistent with what I've been saying for years,
yeah,
because
earnings.
it's a crapshoot. I mean,
Yeah, here's your worst case scenario. Your worst case scenario is you you come in gung ho, you pick your very first swing trade. Yeah, this is the absolute worst case extreme scenario. Pick your first stock, you say, screw all the rules, I'm going all in, I'm going to put I'm going in with margin on this sucker, right? You take a huge position, and then the very next day there would be a catastrophic gap down, and it could wipe out your entire account if you go heavy into margin, right? On one trade, right? That's the absolute worst case scenario. Well, that's really
nobody's
dumb.
gonna
But
do that.
yeah, that's like you might as well just go
Yeah.
bet it all at the craps table, right?
Yeah. Well, hey, let's move on to. I've pulled up the open trades page here, and there's quite a bit to look at, and there's quite a few open trades here. So why don't
Let me
we?
let me just finish about the diversification real quick,
Okay.
before because that's an important topic. The I was just ready to make a point. So the point is with that is the only ways to deal with that is, if you are going to do one trade at a time, like one after the other, again, you just start off very small, and your position sizes are very small. So if let's say you got hit, it would be a sting in your account, but it wouldn't wipe you out, right? Um, it, so here's how this works. And let's say that you're trading over the series, and you're just doing the one after the other kind of trades, right? You're trading over the series, and you're gradually building size up. Now you do get to some pretty big position sizes, and you hit a catastrophic gap. Well, it's not lethal, because to get to that point, you will have made a bunch of money in the market, right? Because you're only building your sizes up on performance over time. And so, still, even though you got hit by a bigger position and a bigger gap down, you'd be eating into probably your profit buffer, right? Your
Gotcha.
house money. Now, real quick, then, the uh, other way to deal with that is to just diversify and trade baskets of stocks. And the preferred size of that basket is probably going to be between 3 and 6 stocks at one time. That doesn't mean you take them all at one on the entries on the same day. As a matter of fact, it's probably better to layer into the stocks over time, right?
Mm-hmm.
So once you kind of layer into your basket, let's say you get to like four or five stocks. Some of the stocks are going to be hitting your targets, and they'll be coming out of the basket, and new stocks will be triggering in. So your goal will be to maintain a basket of anywhere from like 3 to 6 positions, right? And see, here's the great thing. As discretionary swing traders managing our own accounts, we have the ability to just go flat or go straight to cash whenever we want, right? So let's say that we're hitting, we've got some good profits, the market's been going up, we're going to hit a holiday period, we're going to go on vacation, whatever. You have the total ability to just go flat, and then you just start the cycle all over again. You try to rebuild that basket. Um, Now that's how you could, over time get large accounts fully into the market, or mostly working in the market by this rotational method. Uh, and Your max profit level ratio is like maximum about 6 stocks. As you go more than that, your results are just going to get more and more mediocre, and
Mm-hmm.
your commission costs go up too. So
Sure.
keep it between like 3 and 6. So there's my
All right. Well, that makes perfect sense. I've moved over to the open trades page, and for a minute here, let's talk about just what we're seeing in this table here. So when a stock actually triggers, it appears in the triggered today list, and then it also appears that same day in the open trades. Correct?
Yeah, the way it works is exactly right. You're going to get the stock pop into the triggered table, and that's for your convenience, just because you'll just have a steady stream of symbols that you can see right away, like that are triggering. You don't have to hunt around and look at the lines and see which ones, right? I
Yeah,
mean,
from
think
the
about,
pen, you don't have to go down the pending list and try and
yeah,
figure out which ones actually closed above the trigger price. They're
yeah, that would
right
be a
there
pain.
for you.
That would be a pain in the what every day, right? So the
Yeah.
triggered table just gives them to you on a silver platter, and then the fact that they trigger, we're going to consider that like an open trade. Now I might get. See, we're splitting hairs here because I was going to say we might get it to where it has to be trade above it the next day, but then like I just said, the real active trader, you could take the trade the first day. So I think we have to stick with any stock that just closes above that trigger line, will count as like an open trade.
Okay, I like that.
So yeah, once it's in the open trades table, um, it doesn't, and again, it doesn't mean you have to be in all these, but what's going to happen now, the system's going to monitor the swing cycle, and you're going to get an initial stop, right? The column there for the stop, that is your initial protective stop loss right as the stock gets in the list, and then each successive day the trailing stop can kick in, right? So it's going to adjust.
So that's an important thing to keep in mind is that when you're in one of these positions, this stop theoretically can change day to day based on what the stock actually does, based on the price movement, I'm assuming.
Correct. Yeah, you may see the that stop start to move quickly, and that would represent that the stock's actually moving quickly in your favor. Or if the stock's not really moving very much, that stop loss is going to stay static for a while. And that's your line in the sand. That's where you just want to exit the trade, no questions asked. Again, we go back to the law of large numbers and trading over the series. There's only so much fine tuning and technical analysis we can do to get us to the candidate, the setup, the trigger, and then beyond that, it's just it's a crapshoot, because news can come in on that particular stock and affect it, positive or negative. And so don't fret too much about trying to rethink these numbers, because again, over the series it doesn't matter. It's just the stuff will just cancel it.
So this is a hard stop, right?
Hard stop. Just
All
don't
right.
not. I put in the strategy page. It's a hard, non-negotiable stop.
Gotcha.
It's only, in other words, once you see that number, it can only move higher. Right? You don't want to ever lower the stop. The reason why is because we hit a point of, if that stock's going to come down and hit that level, then you open yourself up to catastrophic loss. The stock could, if the stock penetrates that level and starts, a new downtrend, you could see, you could see catastrophic loss. I have lots of stories like that in my trading career where I second thunk the stop, right? Because I kind of was looking at the patterns and saying, it's it's probably going to go back up, or I was enamored with the stock itself, and I kind of broke the rule and let the stock slip, and only to my agony. I mean, a good example is I remember being in a swing trading stock where I could have taken about literally like an $800 stop. Okay, it was a relatively big position, and but I didn't because I thunk it. You know, I was thinking too much about it. I didn't take the hard stop, and 3 months later, it was a $9,000 loss. You see, so yeah, don't rethink that stop. That's a hard stop. If it gets hit, it's just another. You're out. You know, cut your losses quick. Move on.
Yeah, and
If
theoretically, with a diversified portfolio, no one stop getting hit is going to have extreme adverse um, implications to your portfolio.
Well, right, and even if you're trading one stock at a time, it shouldn't either, because if you start off with very small position sizes and build up, it's all relative, right? Later on, if you're trading a big position and the stop gets hit, you're just stopping out and eating into your house money, your profits, right? Because you see what I'm saying. So,
Sure.
so yeah, the way this is designed is that no matter how you trade it, as long as you start off very small and work your, build your size up over time, you can't hurt yourself too much trading. Either whatever method you choose to trade here.
Let me ask you this. So the stop is going to, as a stock, say, you enter it, it starts moving up. The stop gets ratcheted up, and that's going to be what takes you out of the trade. Am I correct?
Well, that's one methodology to take you out of the trade. We've got in the strategies page there, I outline basically three approaches, and we could argue which one's better than the other, or but they all have like trade-offs and pros and cons, and but they all work. So one methodology is what I've kind of already talked about, the one entry at a time type of trading, where you're picking a stock, you're getting into it, maybe you stay in it for a week or so, maybe you pull off 2 or 3 swing trades a month, right? Maybe more, but it's a one-off, right? One after the other. The other methodology is where you run a basket of stocks, and you try to maintain a certain amount of money in the market at all times, right? You're kind of doing a rotational thing. Now, beyond that, we have 3 different methodologies on execution, right? So I'll go over those real quickly because it's kind of important to understand the options. One is to say, hey, I want to get into these trades, and I want to hit the computed target, and that's it. I want to just, bird in the hand is worth 2 in the bush, right? Grab the profits while they're hot. So you actually would use the target column there. So you'd take your trade, place your hard stop, good till canceled, and then just stick your limit sell order up at the target price. Now the target price is 3.5 times the
ATR?
ATR, the average range computed on that the pending table,
Okay.
and which is a high frequency move in a swing trade. And the cool thing about it is, since it's based off that stock's own average range, the targets are all calibrated specifically for each symbol. You get it? So high frequency move, because here's the way to think about it. Let's say that your stock average range is 3%. Okay, so you're going to get or around 3%, right? You're going to get a target that's out around 10%, right?
Sure.
So here's why this is high frequency, because most of our stocks that are in the swing trading setup, what happens is at the point where they start setting up with a trigger, they're usually at the narrower range of the average range, right?
Gotcha.
And one of the things we see in the swing trading cycle is we see range expansion and range contraction, right? So think about, this is a really great visual in your head here, or maybe I'll do a graphic sometime. in your head, think of like, okay, the balance harmonic is like, 3% average per day, right? Now, what that means is in the swing cycle, there's going to be bigger days that could be 4 or 5 or 6%, and there's going to be tighter days that could be, 1.5, 2%, right? We're we got the average. So the point being is what happens is in the normal swing trading setup, as we get the setup and the trigger, we're usually at the minimum range in
Okay.
the cycle. And the whole goal is that we take the entry, and shortly after our entry, we get range expansion back to the upside, which means that not only is the stock going to be moving in our favor, but the daily ranges are going to start expanding back in our favor. And so this computation gives you high frequency fill targets, because all we're doing is we're saying, hey, if you've been trading on an average of 3% per day, all we're asking at the minimum is just you go, 3 days in my favor,
Hmm.
and we hit that 10% basically, right? But add in the factor that we're going to see range acceleration, range expansion, and that's how we can easily take out these first targets.
Is that first target going to be static? Like we know the stop is going to trail up, but this initial first target, is that basically going to stay where it is once it's computed initially?
Yeah, that's a static target,
Okay.
because all we're doing here is we're going to say, hey, look, from this particular setup, from this trigger, you got a high frequency within, maybe it could be the first day that you hit that target, or it might take a week to wiggle up there. But the point is that's a high frequency target. Now, stocks can go much further than the targets, because if it's all about staying in a runner and maintaining a position, and we all know that a $20 stock can turn into a $40 stock, right?
Sure.
So the point is that the first target's there as a high frequency win, um, and then we have the ability to hang on. So the first methodology is where you basically take the entry, set your stop, put your limit order in for the full position size at the target, and that's it. You don't have to do anything more other than monitor and just move your stop if the trailing stop moves. The second methodology is to say, hey, I want to try to stay in stocks for a little bit more of the longer haul. Again, you take a position, you set your stop. Now you don't put any targets in. You just let the trailing stop take you out. So what's going to happen is you'll get stocks that you'll get stopped out, right? They just maybe there's news that comes out and it knocks pulls the rug out from under the setup, or the markets just kind of fizzle, and they don't follow through, and so stocks kind of fizzle. We get some stop outs, but then you're going to get stocks that do move in your favor, and you'll see that the trailing stop will start to trail along, right?
Hmm.
And again, the great thing about how you can trade off of this system is you can make it as hard or complex as you want, or as easy as you want. If you're the tinker that wants to study every moving average on the charts and look at everything, great. You got a steady supply of symbols to work with. If you're the casual swing trader that's a busy working professional or something, and you don't want to fret about all this stuff, you just place your entries, you put your hard stops in, good till canceled, and you just let the system play out. Because again, as long as you start off really, really, really small, and we can talk about that in a minute if you want, Bill, you can continue through the series, no fear, and eventually you'll see over the series your edge kicks in and your results start to pile up. You can start increasing the size. You see,
Sure.
so the second methodology is a nice methodology as well, where you just let the trailing stop be your exit. That could keep you in a stock for 6 weeks,
Is
and while you're seeing great big gains, right? You
sure.
could you could blow past that first target by 3 or 4 times past that target.
As far as the stock being removed from this open trades table, is it going to be when it does hit the trailing stop?
Yeah, that's a good point because we gotta have something that knocks it out of the list. So according to this system, that's the LMO. If the price comes down, whether it's the initial trailing stop that gets hit with a big loss, a loss, the full loss, or it's a trailing stop later on that gets hit, that's what knocks it out of the list. So
Okay.
basically, following that methodology, you're going to see three outcomes. You're going to see either your full stop just gets hit, right? The stock just can't get off the launching pad. You're going to see the trailing stop will kick in, and maybe by the time, a few days into the trade or whatever, that trailing stop is up around your entry point, and then the stock comes back and hits the stop. Now you just got knocked out like at or around break even, right?
Mm-hmm.
So it wasn't a loss. Your other option is you'll get trades that'll run and um, you'll be out with a profit, and you'll have big winners that you stay in for weeks if you just do that, and you'll have others that they'll peter out after 10 days maybe and knock you out with a profit. Now the third methodology, real quick, is to combine the two, and little bit more work. You're going to have a little bit more commissions. It's not a big deal. But what you do is you buy into the pros of both of them, of both of those strategies, and that is what you're doing is your first target is to sell half the position, and so we call that a delta target. It's a name I kind of made up or stole like a couple years ago. The delta target, that's the first target in there, you pull half off the table, and then you let the rest ride with the system trailing stop. So you can combine the two of them. Now, the final thing I'll say about that is you don't have to fret about which one's better, which one's worse, and which one do I have to pick. You can adapt, and one stock you could trade one way, and another stock you could pick another strategy, right?
Mm-hmm.
So in other words, and it also has to do with market conditions. Let's say that the market just made a giant down move and we're expecting a bounce. You might just want to play that bounce and take the quick profits on everything, right? And not worry about, well, is it going to be like a fake bounce, right?
Yep.
And I might give it all back. Or if the market's in a really good up phase, you might say, hey, I want to try to stay in some of these stocks with good patterns that could go much higher, right? So you see, you can mix and match a little bit and adapt and change your strategies around.
Yeah, so it can make sense to take half off at the initial target, like you say, which is a high probability fill zone, and then hang on for a much bigger move using the trailing stop, which brings me to the P stop, which stands for parabolic trailing stop. Why don't you talk about that for a minute?
Yeah, what you're going to see is here's the dilemma that we face. Okay, if we're going to use the system trailing stop, um, the whole thing about stops is if they're too close, you're just going to get knocked out, and you're either knocked out with a loss, and then the trade can go on and work, right? So you lost money in a trade and you're not in it, but the dang trade still works, right?
Mm-hmm.
That's a risk we have if we have the stop just too tight. So we have to maintain a healthy wiggle room. However, if the stock's going to fail, the stock's going to fail. We don't want to give it too much wiggle room so in other words, the stop and the trailing stop have to be computed really delicately to give us enough wiggle room, but also to make sure, hey, we want to like protect as much as possible, right? We don't want to give too much back. So here's our dilemma with that, and there is a bit of logic built into the trailing stop to accelerate as well. So as the stock cycles and moves in our favor, and so we're seeing price maybe go higher over the coming days and weeks, that trailing stop is going to follow up, and it's going to, again, it's going to maintain enough wiggle room and a healthy distance, and it will lock in profits. However, if the market goes super parabolic, meaning it, and you, this is characterized by like maybe a couple long range days to the upside and some gap ups.
Mm-hmm.
That trailing stop is going to trail and accelerate, but it's still going to be, you know,
A pretty good distance
a
away.
good distance, because
Yeah.
here's why. That trailing stop is designed to keep you in for the long, as long as possible.
Gotcha.
So, we can see stocks accelerate really big and then they pull way back, and then they, maybe weeks later they start up again. And that trailing stop could keep you into that. Okay. Now, however, if you're in a trade that's really giving you some good returns and you get a big move like that, you may say, "Hey, I want to just squeeze out the last juice out of this trade, right? And just take the profits." And that's what that parabolic stop is for. So I mentioned in the strategies page that, like, you could say, "Hey, if I stay in a runner and I'm like 2 to 3 times the average range past the trigger price, right? Or maybe it could be double the target price, or maybe it could just be somewhere you see on a chart that you think there's going to be resistance, and you start getting these parabolic stops. That's where you start tightening. So these are really super tight stops. Many times they're going to be like right below the previous day's low.
So the parabolic stop is going to kick in after a stock has like had maybe a couple of big long range days up, made a significant move in a short amount of time. You see the parabolic stop kick in, and that's your sort of indication to get ready to tighten up the stop and take some profits.
Yeah, you could either exit the entire position if you've been, like I said, if you've been in a swing trade that not only went through the system target, but you're like 2 or 3 times past that system target, and you really have gone for a good run, and you start getting these parabolic stops. You have the option to just pull it all off the table, or like that's where you could set and take half again, right?
Mm-hmm.
There's another way to do this, and again, you've got all these different angles and ways you can play the market. So don't overcomplicate it too much, but just to talk about how you could do it. Let's say that you took a trade, you didn't take half off at
Target.
the delta target, and you just maintain the entire position on the full position using the trailing stop, and then maybe later you're already past the target. Maybe later you start seeing these parabolic stops come in. Now you go ahead and say, okay, now I'm going to take half off with using the parabolic stop, right? So that's another methodology. Now you're maybe even getting a bigger gain on the first half of your position, you see. And the great thing about this is this: once you pull off half, regardless of how you do it, either by hitting the target or just using a parabolic stop, once you pull half off, you're typically pretty much at a virtual break even status. Like, you can't lose at that point.
Gotcha.
So that is one of your main focal points, is like, hey, just get me, either just get me to the target and let me pull half off, or when I hit a parabolic stop, I'll take half off. Once you do that, you're pretty much at break even on your trade, and there's no risk of loss on the rest of the position.
Gotcha. So real quick on these open trades, like these three are the ones that would have triggered today, because like these three were the ones that closed above their trigger price, and so this morning you would look at the stock around the open and say, okay, is this stock trading above the trigger price? If so, then jump on in. This particular stock that I'm looking at here, the second one, I noticed, pulled up the chart while you were talking, and it's below the trigger price, right? Nah, not by a whole lot, and so this one actually, would not have triggered. So let me ask you this: is this going to be on? Suppose this doesn't trigger today, like TRI doesn't hit 4830. Will it still be in this table tomorrow? Is it still viable for like tomorrow and the next day, or is there going to be like a couple of days pass by, it trading below the trigger price, and so it's just going to drop off of here?
Yeah, the way that it's set up now, it's just going to drop off. It'll go into the open trades. So that's some minutia. We're going to have to figure out exactly how we're going to split those hairs, because it can get really picky there, right?
Sure.
Because I just told you, like, one option is to, the day it's moving above and going to close, you could take the entry on that day. So how would we account for that? So,
Ah,
right,
gotcha.
in other words, we'd want to have it drop into the open trades list if somebody took the entry like that, because they're going to want to track, right? So I
Okay.
think I think we have to leave it the way it is, and yeah, remember, you have the ability to just jot down on a piece of paper which trades triggered. So even if they weren't on the list, you could see, okay, you can write down what the trigger price was, um, and you're going to find them in the open trades table then too, to go in and see where the trigger was. Uh, so
Sure.
yeah, I think that's the way we're going to
Okay.
have to do that.
Yeah, yeah, and of course we got the print button on the on the
Right,
pending
you got the
trades.
print button, you got
And the
the
CSV.
download
Yeah, and I could
CSV.
I could probably add that to this too. We actually had a question come in. Somebody was asking if we're going to add the position size calculators to this to make it easy for them to calculate the position sizes, and so I think that's actually doable, right?
Yeah, great question. That's exactly what we're going to do. That's one of our next little projects. I'll be programming that here shortly, and we'll get in all the handy dandy calculators that we have for swing trading that have been in our software in the past. And so yeah, that'll be like one of the next upgrades that I think we'll see, is we'll get those calculators in there.
Very cool, very cool. Um, All right, so obviously there's a lot more we can cover, and we'll be doing these shows each week, and we'll be getting more questions, and so I just want to let everybody know that this is still a little bit of a work in development. It's fully functional. We got everything, pretty much fine tuned on the back end. It's definitely working and actionable, but it will improve as we go forward. And so there's a lot of really cool stuff that we've thought of, different directions we can go with this type of thing in the future, right?
Yeah, correct. The great thing about this system here is, and for those of you who maybe are listening to this and relatively new here, Bill and I have been developing swing trading software for what, 15 years?
Yeah.
Yeah, and we've come out with a lot of products, really good products that have been like bestsellers on the internet and all that. And they have had lots of different setups and lots of different calculators and lots of different strategies. And so what we're doing here is we're taking like the best of the best, cream of the crop stuff, and simplified it way down so that you don't have to do too much technical analysis, right? You can just play the symbols as they come on the list, and use the mechanical targets, mechanical stops. And as long as again, the biggest part of this, you can't get hurt by any of this if you start off with very, very tiny position sizes. You want to talk about that for a little bit?
Yeah, sure.
Yeah.
Let's talk about position sizes, and talk about, again, maybe reiterate, how you would want to trade a basket of these.
Yeah, so this is probably the most important part of this to get in swing trading. If you go in and you are gung ho and you're saying like, "Hey, damn the torpedoes! Looks great. I'm going all in," uh, and your position sizes are really big. What could happen is that markets are cyclical. Markets are bipolar, meaning that markets give us great conditions until they don't, and then the conditions can get sluggish and choppy and non-productive, and the follow-through isn't very good, and that can last for a while, right?
Mm-hmm.
So think of that in your swing trading, that um, we go through these kinds of cycles, and uh, your dumb luck is you could start off like right when we're in a tricky market, or stocks aren't really following through very good, right?
Mm-hmm.
And take some big stops, right? And so you're going to see that eat away at your account right away, and you're going to go, oh crap, this system don't work, and you abandon ship and you go, I got to go find something new, right? The whole time you have like a really great system in your hands, okay? uh, so this is, and this is the main thing that knocks traders out, is they don't understand the concept of like progression, position size progression. So back to my analogy. Yeah, if you take big hits too quick, and it's not your fault or anything, it's just like crappy conditions and your dumb luck, then you're likely to abandon ship and you stop the series. And the series is what gives us our edge. So the point being is, you go to the other spectrum. If you start off so tiny that, like, going out to the Dairy Queen with your spouse and your kids or whatever is more than you'll lose on each trade, then you're not going to get nervous, right? You're going to basically continue to trade through the series. So my advice is, doesn't matter if you have, you know, gobs of money in your account, start off really tiny. And a great way to do this is there's two ways to determine your position size. The easy way is just say, hey, dollar amount per trade. So let's say that you had I don't know, like a $25,000 account. Start off with, like $1,000 positions. They're very tiny. It's not about how much money you're going to make. What you want to focus on is what kind of percentage returns are you capturing.
Mm-hmm.
Don't worry about the money, right? Um, Focus on, like, over the series, what kind of percentage gains am I making. As soon as you see that that's positive, you can start increasing the size gradually. So basically you're pulling yourself up by your own bootstraps. That's how you weather any kind of sluggish start to your system in crappy conditions, right? So the biggest story you'll ever hear is, people say, oh, I paper traded this for weeks, and right as I started it, it's lost, started losing, right? Dumb luck, right? So you got to be able to, if you can prove a system works over the series, which this system does, it's everything's calibrated to work over the series. All you got to do is stick with the series. And in your accounts, the way you do that is you just start off with very small, tiny sizes. And so a great way to do this is, swing trading is a slower process, because we got to wait for trades to develop, and we could be in swing trades for 2 weeks, 3 weeks sometimes if they're running. So you may want to say, okay, I'm going to start off at a particular level, and I'm going to trade that for 2 months. At 2 months, I'll evaluate and see what my P&L is, and if it's positive, I'm going to, double the size, and you just do that your first year, and you'll be up and running. You'll pad your account with lots of risk capital. So the other way is to fix the risk per trade. Like I was saying, what I was saying earlier, you could say, hey, I'm going to only risk $50 a trade, right? And it's going to
Mm-hmm.
tell you how many shares to buy.
Yeah.
Yeah. So that is and the final thing I'll say about this is that one final thing you can do to just ensure and really lessen the not only lessen the risk, but just put you even at more ease, is to trade off a risk capital. So let's say you have a $25,000 account, send in $1,000 on top of that extra, and your promise is you'll never go below 25K, right?
Mm-hmm.
That's your do or die level. You only get to trade off the risk capital. You take that 1,000 and you say, okay, I'm gonna do trades where I only have a $50 risk. So that allows you to do 20 trades if you lost every single trade, right?
Yeah.
You could,
Highly
and
unlikely.
well, yeah, it's almost impossible. Uh, that's impossible. So that's going to allow you to, it's going to allow the series to kick in to give you the edge. You see, that's the best way to get started right there. Send in risk capital, trade really tiny positions, and that way, if after everything is said and done, if things still don't go your way, you got your 25K there, right?
Sure, sure, makes a lot of sense. So, yeah, hey, I'm not sure if there was anything else you wanted to cover, but I wanted to keep this sort of at a reasonable time here, and so obviously we will be able to do tutorial videos and record them and put them in. This particular video will be available for replay until we do the next one. And so if anybody has any questions along the way, we will be happy to answer those by email. And I was thinking maybe we should kind of wrap this up here.
Sure.
And
Yeah, I think we covered all the nuances and the nitty gritty and a lot of
pretty much so. The thing that I wanted to kind of stress here is that a lot of what most of what we talked about and everything that you really need to get started and trade this system is documented now in the strategies on the strategies page, and so there's a lot of material down here, and it'll take some time to digest, and but I think it really covers it well, and we've got some additional documentation coming in here, and so I think that is there anything else that you wanted to kind of close with?
No, I was just going to say, here's the thing. As long as you start off extremely small, you can just jump in at any time because the risk is so low that on your account that there's nothing to fear. Just dive in. Normally, I would say, like we were talking about day trading or the futures market, you definitely want to paper trade. Um,
For a period of time to kind of get your feet wet.
Yeah, you definitely want to paper trade for a bit on those before because the leverage is so high. But as long as you start off really small positions on this, you can just jump in, do the live trades, and that's important because then it gets you actually pulling the trigger and monitoring your positions. If you paper trade, you can kind of cheat and say, "Oh yeah, I kind of got in here," and write it down. And no, better to actually pull the trigger and get into live positions, just super small, so that it doesn't affect you one way or the other, win or lose, but you're going for your percentage gains over the
Sure,
series.
and the nature of this whole system is, obviously swing trading is what we specialize in, but this is kind of a patient man's game too, right? Like these trades are going to play out over a period of time, and so it's a very sort of a low stress type thing. I mean, typically the stocks that you're going to see in here, they're not going to be making, huge gains or losses or anything in any short amount of time. And so it's designed to be sort of a laid back type thing where you're not really sweating every single day, this and that, and so just kind of take it easy and progress through the series. You can check it each night, and all the figures will be updated and changing and everything, and so you can adjust your stops kind of at your convenience, right?
Yeah, the whole goal on with this system was to pare the swing trading process down to a level that is so easy to follow and like stress
Mechanical.
free, very mechanical, stress free, systematic, and you're basically just playing the numbers. And again, it's all about starting off small size and just building up on performance. Um, that keeps you in the game, and like I said, our edge, our profit potential comes over the series. What that basically means is it doesn't mean that you couldn't get in your first 2 weeks and make a bundle, right?
Hmm.
Because you're catching the best swing trade entries on the best market conditions, right? It doesn't mean that that couldn't happen. Um, but it means that the markets go through periods of we get really super hot markets and then we get dull choppy markets, and there's no way to accurately predict exactly from when one type of market's going to morph into a different type of market. So we just have to stay in the game and progress through the series, and that's what helps average everything out and gives us our net profit potential. So yeah,
Gotcha, gotcha. Okay, well, we'll figure out what the questions are. Anybody has any questions, feel free to email us, and we will cover those in the documentation and on future shows. So, I appreciate you showing up this morning and giving us a good overview. And
no problem.
this video, as I say, will be available um, in the future for replay for everybody that missed it. And so we'll continue to plug away on this, and then a week from today we should have some neat new stuff to talk about. So let's go ahead and wrap it up.
Very
And
good.
I
Yeah.
appreciate it, Jeffrey, and I will talk to you next time.
Yeah, we'll talk to you next week.